Last week, I looked at my savings account statement and realized I earned 4 cents in interest. I don't know what I'm supposed to do with 4 cents, but I also don't know anything about personal finance. I have heard the term high yield savings account or HYSA before, but I wanted to learn more about what that was and how it was different from the savings account that I was using. Here's what I learned from 5 hours of research. Most of us keep our money in a big bank checking or savings account. Think Wells Fargo or Chase. These banks both have a standard annual percentage yield or APY of 0.01% for their standard savings accounts. SoFi is a bank that offers an HYSA with an APY of 3.3%. That doesn't sound like a big difference until you sit down and actually do the math. If you keep $1,000 in a savings account with a 0.01% APY for 1 year, you will earn 10 cents at the end of that year. However, if you keep $1,000 in a savings account with a 3.3% APY for 1 year, you will earn $33.55. You earn over 300 times more money in this scenario for just keeping your money in a different savings account. If $33 doesn't sound like a lot, which in the grand scheme of things, it really isn't, imagine that you keep $10,000 in those savings accounts instead of 1,000. At the end of the year, you could either have $1 or $335.49. When I first saw this, I thought, this sounds like a no-brainer. Of course, I want to keep my money in an HYSA. But I also thought, this has to be some kind of a scam. Why would they just give me free money? Well, the secret is these banks, like SoFi, usually don't have physical buildings. They don't have thousands of branches like Wells Fargo or Chase do, where they have to pay rent or pay people to run those branches. They pass those savings on to us in the form of higher interest. And to answer the question of, is it safe? Well, yes, it is. I found out that as long as the bank is FDIC insured, your money is protected by the government. If the bank disappeared tomorrow, the government would have to write you a check. All of that sounded great, but I wanted to understand what the catch was. The first and biggest thing that I found is that the APY is variable, which means the rate can go up or down based on what the Federal Reserve does. I don't exactly know what the Federal Reserve does, but I'll save that for another day. The next catch is that a lot of these HYSAs require a minimum balance or for you to link your direct deposit. I know for a fact that SoFi requires that you link your direct deposit, but there is no minimum deposit amount. If you're clueless like I was, the easiest way to start is to just find a bank that has an HYSA, go on their website, and open an account with them. After doing a little bit of research, I chose to go with SoFi, but that was mainly because they have an NFL stadium named after them. This was the first thing I learned on my journey from being clueless about personal finance to becoming, well, just a little bit less clueless. If this helped you, hit the like button, subscribe, and leave a comment if there's something that you're clueless about and want to learn more of. See you guys next time.